London, 1957. Inside a modest office not far from the Bank of England, a clerk from a Soviet-owned bank places a call to New York. He needs to move several $1 million, dollars earned from Soviet gold sales, from grain settlements, from the ordinary business of a state that still needs hard currency to function in a world it claims to be ideologically opposed to. But he doesn't want those dollars sitting in an American bank account. Not anymore. Not after what Washington has already shown itself willing to do. Because if the United States decides on any given morning to freeze Soviet assets, and by 1957, that fear isn't paranoia, it's precedent, drawn directly from wartime asset seizures still fresh in institutional memory, every dollar sitting in a New York vault becomes a hostage, a bargaining chip, a lever Washington can pull without firing a single shot. So the clerk does something almost nobody has done at this scale before. He asks a British bank to hold the dollars instead, not to convert them into pounds sterling, not to exchange them for something safer, something British, something outside American reach in the way currency conversion usually implies. He asks the bank to hold the dollars, as dollars on European soil, entirely outside the jurisdiction of the country whose name is printed on every bill. Nobody in that room understands what they've just built. There's no ribbon-cutting ceremony, no treaty signing, no summit of finance ministers shaking hands for the cameras, the way there was in 1944 when the post-war monetary order was supposedly settled for good. Just a quiet workaround born out of fear, executed in an ordinary afternoon, filed away as an unremarkable transaction in an unremarkable ledger. You were taught that the modern dollar system was designed at Bretton Woods in July of 1944, 44 allied nations, one hotel in the mountains of New Hampshire, one grand architecture for the post-war world laid out over 3 weeks of negotiation, fixed exchange rates between currencies, the dollar pegged to gold at $35 an ounce, every other major currency pegged, in turn, to the dollar. A system engineered by economists like John Maynard Keynes and Harry Dexter White, signed by statesmen, built deliberately, painstakingly, to prevent the currency chaos that had helped drag the world into economic collapse and war twice already that century. Here's what they don't teach you in the version of this story that makes it into textbooks. The system that actually runs the world today, the one where trillions of dollars move across borders every single day, held by banks that no single government fully regulates, financing trade and speculation, and entire national economies without ever touching the country whose currency it technically is, wasn't designed at any conference table. It wasn't debated in any parliament. It wasn't voted on by any body with the authority to approve or reject it. It wasn't even noticed for years by the regulators who were supposed to be watching every dollar that moved. It was invented, almost by accident, by a handful of Soviet bankers trying to hide their money from the United States. This is the story of the Eurodollar market, not a market Washington built. Not a market London planned, in the sense of sitting down and designing it on purpose. A market born from a single act of fear, Cold War fear, institutional fear, the fear of a state that had watched its adversary freeze assets before and had no reason to believe it wouldn't happen again, and one that nearly 70 years later still dictates how money actually moves through the global economy, far outside the system the textbooks tell you is in charge. By the time you understand who actually made the first move, which bank, which building, which specific transaction set the pattern that every offshore dollar since has followed, you'll understand why every modern shadow bank, every regulatory gap exploited by 21st century finance, every tax haven that makes headlines when the next leak of financial documents surfaces, still traces its underlying logic back to that quiet office in London. To understand why a Soviet bank needed to hide dollars from the United States, you have to understand what the dollar had become by the 1950s, and why holding it was starting to feel less like safety and more like exposure, even for institutions with no obvious reason to fear an American bank. The story of that exposure begins, in a sense, 3 years earlier than the London transaction, in the summer of 1944, at the Mount Washington Hotel in Bretton Woods, New Hampshire. Representatives of 44 nations gathered there to design, from scratch, the financial architecture of the post-war world, and the negotiation that produced it was far more contested than the tidy textbook summary suggests. The two dominant figures at the table, John Maynard Keynes representing a Britain already fading as a financial power, and Harry Dexter White representing an America ascending to unquestioned dominance, disagreed sharply about what that architecture should look like. Keynes proposed an international clearing union built around a new supranational currency, something that would prevent any single nation's currency from becoming the world's reserve currency by default, and would spread the burden of adjustment between debtor and creditor nations alike. White, backed by the overwhelming economic and political leverage of a United States that had just financed an entire global war and emerged with most of the world's monetary gold, proposed something far simpler and far more advantageous to Washington: peg the dollar to gold and peg everything else to the dollar. White's vision won, decisively, because the United States held essentially all the leverage in that room. Britain was exhausted, indebted, and in no position to insist on Keynes's more balanced architecture. That victory is the seed of everything that follows in this story. Bretton Woods didn't just create a fixed exchange rate system. It created a world in which the dollar itself became the base layer of international trust, and in which the country issuing that dollar retained sole, unilateral control over who could access it and under what conditions. Nobody at that negotiating table, in 1944, seriously debated what would happen if a government the United States considered hostile needed to hold dollars but didn't trust the country issuing them. That scenario simply wasn't the problem Bretton Woods was built to solve. Bretton Woods had done exactly what it was built to do. It made the dollar the anchor of the post-war world, and it did so by design, not accident. Every major currency pegged itself to the dollar within a narrow band. The dollar alone pegged itself to gold. At that fixed rate, the United States guaranteed to honor for any foreign central bank that asked. For the rest of the world, holding dollars meant holding something as good as gold, liquid, universally accepted, backed by the world's largest economy and its explicit promise of convertibility. But trust in a currency is never really trust in a metal sitting in a vault in Kentucky. It's trust in the government that controls access to that currency, that decides who gets to hold it, move it, and use it, and who doesn't. And by the mid-1950s, the government that controlled the dollar had shown, more than once, that it was fully willing to freeze the dollar assets of anyone it considered an adversary, without warning, without negotiation, and without much regard for how that decision would look a decade later. The precedent went back further than most people realize, and it wasn't subtle. During the Second World War, the United States froze the dollar assets of nations it went to war with, cutting off access overnight to funds that had, the day before, been treated as ordinary deposits. It happened again, in different forms, in the years immediately after, as Washington used financial leverage as a matter of routine foreign policy. It was a tool the United States had used before, openly, and everyone watching international finance in the 1950s understood it could be used again, against anyone, for any reason Washington considered sufficient. For the Soviet Union, in the depths of the Cold War, holding significant dollar reserves inside the American banking system wasn't a minor technicality to be managed by a compliance department. It was a standing structural risk, sitting there every single day. One geopolitical incident, a Berlin crisis, a proxy conflict escalating somewhere in the developing world, a diplomatic rupture nobody saw coming, and those dollars could vanish behind a single executive order, with no court to appeal to and no international body with the power to reverse it. At the same time, the USSR couldn't simply avoid the dollar altogether, however much ideological comfort that might have provided. Global trade in the 1950s ran overwhelmingly on the dollar. Gold sales, grain purchases from Western markets during years of poor harvests, machinery and technology, imports the Soviet economy genuinely needed. All of it settled, ultimately, in dollars, because dollars were what the rest of the trading world accepted without hesitation. The Soviets needed the world's most useful currency without exposing themselves to the world's most dangerous counterparty, the very country that issued it and controlled every account denominated in it. So Soviet state banks, principally Moscow Narodny Bank, operating out of London, and the Banque Commerciale pour l'Europe du Nord, operating out of Paris, began doing something quietly radical, something that had no obvious name yet because nobody had needed one before. They kept their dollar earnings as dollars. But instead of depositing those dollars with a bank inside the United States, where any dollar transaction naturally seemed to belong, they deposited them with banks in London and Paris. The money never touched American soil. It never sat inside an account a single signature in Washington could freeze. Here's what most people miss about this moment, and it's the detail that explains everything that followed. Nobody had explicitly banned this. There was no clause in the Bretton Woods agreements, no regulation on either side of the Atlantic, that prevented a European bank from accepting a deposit denominated in dollars and simply holding it as dollars, rather than converting it into sterling or francs the way convention assumed it would. The entire post-war financial architecture had been built to regulate currencies within the nations that issued them. It had simply never anticipated that a currency might exist, in serious volume, entirely outside the country whose name was on it. Bretton Woods regulated the dollar inside America, and it regulated how other currencies related to the dollar. It never regulated because nobody imagined it needed to, dollars existing and circulating and being lent and borrowed entirely among banks that weren't American at all. That blind spot, that single unexamined gap in an otherwise meticulously designed system, is the crack the eurodollar market grew through, and once it existed, it would prove almost impossible to close. Two Soviet-controlled institutions did more than any other single actor to open that crack. Moscow Narodny Bank, operating out of London since the 1920s as the USSR's principal window into Western finance, and the Banque Commerciale pour l'Europe du Nord, its Paris-based counterpart, known in Soviet cable traffic and later in financial folklore that most people have never heard by its telex address, Eurobank. That name is not a detail you should skip past. When traders across London started referring, informally, to these new offshore dollar deposits, they needed a shorthand, some quick way to say dollars held in Europe, denominated in dollars, but entirely outside US jurisdiction. They borrowed the term directly from the Soviet bank's own telex identity. The market that would eventually grow to tens of trillions of dollars, the market that underwrites a staggering share of modern international finance, is named, informally, almost as an inside joke among 1950s London traders, after a Soviet state bank's cable address. Sit with that for a second, because it rarely gets more than a passing mention in most retellings. The single most consequential financial innovation of the post-war era carries, buried in its own casual nickname, a quiet admission of exactly where it came from. But Moscow Narodny and BCEN weren't operating in a vacuum, and their motives alone don't explain how this scaled from a handful of cautious transactions into a self-sustaining global market. They needed willing counterparties, British and French banks prepared to accept dollar deposits and hold them as dollars, rather than insisting, as convention and habit would have suggested, on converting everything into the local currency. And in London specifically, they found an entire financial establishment quietly eager, for its own reasons, to say yes. Post-war Britain was capital-controlled and sterling-constrained in ways that are easy to forget from the present day. The pound was weak, tightly regulated under strict exchange controls, and increasingly marginal on the world stage compared to its pre-war dominance. London's bankers watched New York consolidate its position as the undisputed center of global finance throughout the 1940s and into the 1950s, and they understood something uncomfortable about their own position. If the City of London had nothing to trade in but a shrinking, tightly restricted currency, London itself would shrink along with it, year after year, relative to Wall Street. Dollars deposited by Soviet banks weren't just money to be minded on someone else's behalf. They were, for London's banking establishment, something closer to a lifeline, a reason for international capital to keep flowing through the city even as the sterling-based system contracted around it under the weight of capital controls, and a currency nobody particularly wanted to hold. British bankers, as a rule, didn't ask too many pointed questions about why the Soviets specifically preferred London over New York. They simply opened the door quietly and kept it open. Then in 1957, London's own regulators handed the market its second, and by far its larger, gift, and they did it entirely by accident, with no awareness of what they were setting in motion. Facing a sterling crisis in the aftermath of the Suez Crisis, and the run on the pound that followed Britain's humiliating diplomatic and military climbdown, the Bank of England moved to restrict British banks from using sterling to finance third-country trade, precisely the kind of international trade financing that had been the foundation of London's reputation as a financial center for well over a century. British banks, cut off overnight from using their own national currency for a core line of their business, needed an alternative almost immediately, before their trade financing operations withered entirely. The dollar deposits already quietly accumulating from Soviet sources, and from a growing number of other cautious depositors who'd noticed the same regulatory blind spot, were sitting right there, unused for this purpose but perfectly suited to it. British banks simply redirected their trade financing into dollars instead of sterling. Dollars they now had ready and growing access to, dollars nobody in Washington was tracking as part of the domestic American money supply, dollars that never had to touch an American bank or trigger an American regulator's attention. What had started as a narrow Cold War workaround for hiding Soviet reserves became, almost overnight, the default mechanism for financing an enormous share of world trade passing through London. And once other players noticed what had quietly been built, oil-exporting states wary of the exact same asset freeze risk the Soviets had originally feared, multinational corporations looking for a way around U.S. interest rate ceilings and reserve requirements, banks everywhere hungry for a market with no reserve requirements and no central bank looking over their shoulder. The floodgates opened for good, and there was no meaningful mechanism left to close them. If you want a single moment to anchor this entire story, the moment the workaround stopped being a workaround and became a market in its own right, most financial historians who have traced this history point to a specific transaction in early 1957. A Soviet-linked dollar deposit routed through Midland Bank in London, placed there specifically to keep it outside the reach of American jurisdiction, and deployed almost immediately afterward to help fund exactly the kind of trade financing that the Bank of England's sterling restrictions had just frozen out of the pound. That single transaction did two things simultaneously, and both of them mattered enormously for what came next. It proved in practice rather than theory that dollars could be held, loaned, and settled entirely outside the United States, with no American bank ever touching the money at any point in the chain. And it proved that London's own banks, facing their own regulatory squeeze from an entirely separate direction, were not merely willing participants in someone else's Cold War workaround, but active architects in their own right, eager to build an entire parallel financial system rather than watch their core trade financing business die under sterling restrictions they had no power to overturn. From that point forward, the underlying mechanics were almost trivially simple, and that simplicity is exactly why the market scaled as fast as it did. Picture a single deposit of, say, $10 million placed by a bank in London. That bank doesn't simply sit on the money. It lends those same $10 million to another bank, perhaps in Zurich, which needs dollars to finance a client's trade transaction. The Zurich bank, once it holds that deposit, can lend it onward again to a bank in Paris or Tokyo or back to London itself, each transaction in the chain adding another layer of interest, another counterparty, another degree of separation from the original depositor, without a single dollar bill ever physically moving anywhere at all. The same $10 million, recorded across a chain of interbank ledger entries, could effectively finance many multiples of its own face value in trade and lending activity, all of it happening in a regulatory space where none of the participating banks were required to hold reserves against the deposits the way an American bank was legally required to. None of it was subject to the reserve requirements the Federal Reserve imposed on every domestic American bank. None of it was subject to the interest rate ceilings Washington placed on domestic American deposits under regulations like Regulation Q, which capped the interest American banks could legally offer depositors, and in doing so, made dollar deposits in London, free from any such ceiling, considerably more attractive to anyone with dollars to place. By the early 1960s, this interbank lending chain had grown sophisticated enough that London banks were quoting a daily rate at which they'd lend to one another, the earliest ancestor of what the world would eventually come to know as LIBOR. The London Interbank Offered Rate, a benchmark that would go on to underpin trillions of dollars in loans and derivatives contracts across the entire global financial system for the next half-century. Alongside the deposit market, a parallel market emerged by the mid-1960s that made the offshore dollar system even more permanent, the Eurobond market, in which corporations and governments began issuing dollar-denominated bonds outside the United States entirely, sold to investors who wanted dollar exposure without the reporting requirements and withholding taxes attached to U.S. domestic securities. The first widely credited Eurobond issuance, floated by an Italian state highway authority in 1963, raised dollars in London for a European borrower without ever touching an American exchange or an American regulator. It confirmed something the deposit market had already suggested. Dollars had become, for all practical purposes, a stateless currency, as available and as usable outside America as inside it, and in some ways more useful outside, precisely because nobody outside was watching as closely. Here's the part that should genuinely unsettle you, more than the espionage-adjacent origin story itself. Every regulatory advantage the eurodollar market offered existed specifically because no single government claimed jurisdiction over it, and each government involved had a ready-made excuse for looking away. The dollars themselves were American currency, unambiguously. The banks holding and lending them were British, French, eventually Swiss, then Japanese and Middle Eastern as the market spread. The regulators on each side looked at the exact same transactions, and each concluded, independently and conveniently, that it wasn't their problem to solve. The Federal Reserve saw dollars sitting outside America and assumed British and European regulators were watching them closely. British and European regulators saw dollar-denominated transactions and assumed America's own banking rules already covered them, since the currency itself was American. Nobody on either side of the Atlantic was actually watching closely. That was the entire structural point of the arrangement, whether or not any single participant had set out to design it that way, and it was never meaningfully corrected, because by the time anyone in a position of real regulatory power fully grasped what had quietly grown up in the gaps of the post-war system, the market had already become too large, too useful to too many powerful institutions, and too profitable for entirely too many people with influence over whether it got shut down. By the early 1960s, what began as a handful of cautious Soviet deposits had become a self-sustaining interbank market worth billions of dollars, trading among dozens of banks with no single supervisor. By the 1980s, that figure had climbed into the trillions. Today, conservative estimates of the total eurodollar market, dollars held and lent outside the United States, across a genuinely global network of institutions, run into the tens of trillions, a shadow financial system larger, by most measures, than the regulated domestic banking system it quietly grew up alongside and eventually outgrew. Here's the thesis this entire video has been building toward: the eurodollar market was never fixed. It was never brought fully under a unified regulatory roof, and it still isn't, 7 decades on. Every offshore banking center that exists today and makes headlines whenever the next leaked cache of financial documents surfaces, the Cayman Islands, Luxembourg, Singapore's dollar clearing operations, a dozen jurisdictions most people couldn't place on a map, operates on the exact underlying logic that a handful of Cold War-era Soviet bankers stumbled into in a London office in 1957. Move the money outside the jurisdiction that issues it, and the rules that were built to govern it quietly stop applying, not through any explicit exemption, but through the simple absence of anyone whose job it clearly is to enforce them. The 2008 financial crisis exposed, in the most painful way possible, just how enormous and unregulated this shadow dollar system had become by the early 21st century, trillions of dollars moving nightly through institutions that no single central bank fully tracked, creating exactly the kind of systemic blind spot Bretton Woods' original architects never anticipated, because they never imagined a currency existing at real scale, entirely outside the borders of the country that issued it. When that shadow system seized up almost overnight in 2008, central banks around the world discovered they didn't have a clear map of who owed whom, or how much, or in which jurisdiction, a direct, traceable consequence of a market built, from its very first transaction, specifically to avoid being mapped. The emergency dollar swap lines the Federal Reserve extended to foreign central banks that year, quietly propping up a eurodollar system Washington had never designed and could barely see into, were themselves an admission of how completely that regulatory blind spot had endured. And this is the pattern this channel keeps returning to, video after video, because it keeps repeating across completely different eras and different actors. The most powerful financial systems in the modern world are rarely the ones built by design, in daylight, with treaties and signatures and press conferences. They're the ones built by workaround, in the margins, by people who were simply trying to avoid a rule that technically still applied to everyone else, and who never set out to reshape the global economy in the process. A Soviet state bank trying to protect a modest sum of dollar reserves from an American asset freeze accidentally built the offshore financial architecture that multinational corporations, oil-exporting states, and eventually every major Western bank would come to depend on for the rest of the century. The lesson was never designed to be a lesson. Nobody involved in that first transaction in 1957 believed they were laying the foundation for anything larger than their own narrow, defensive purpose. It became the foundation anyway, precisely because nobody else was watching closely enough to stop it while it was still small. So ask yourself the question this channel always leaves you with, because it applies here as much as it applies anywhere else in this history. When the next financial crisis comes, and every pattern in this story says that it will it come from the system everyone's watching, the one with regulators and treaties and oversight committees and public hearings? Or will it come like it did in 1957 and like it did again in 2008 from the part of the system nobody thought was theirs to watch? That's where the real story always begins, not at the signing table, in the ledger nobody was checking.